Welcome to our Quebeco YouTube channel. Before we get started, I'd like you to click on the subscribe button at the bottom to send us an email to inform us that you've subscribed, and we'll send you a free copy of Tax Intelligence by Dr. Daniel Erasmus. This is a book that gets used extensively in transfer pricing disputes. Just click on the subscribe button at the bottom of this video and then click on the bell next to that, and we'll notify you as soon as we upload videos to this channel.
Good day, everyone. In today's podcast, we are talking to transfer pricing expert Mr. Okkie Kellerman. Okkie, we'd like to just welcome you and thank you for taking the time. We do know that you are extremely busy, but thank you very much for taking the time to answer these questions. We've received a number of questions dealing with functional analysis. Some of them are really good questions that some of our students from the Postgraduate Diploma in Transfer Pricing have asked during the course, and we felt that it would be valuable to you, our Tax Tribe members, to share them with you too. So without much further ado, I'm actually going to jump straight into asking the questions. Is it required to perform a functional analysis of comparable transactions by comparable companies so as to establish the economic relevant characteristics? This is because it may be argued that the OECD methodology encourages excessive focus on the controlled transaction with just surface knowledge of the uncontrolled transactions. Hence, a lot of economically relevant differences are not adjusted for. Okkie, if you can answer that, please.
So to perform a functional analysis, you actually need access to the employees, and to have real value in a functional analysis. Unfortunately, you can only do a functional analysis based on your client's details. So when you get to your comparables, then you'll have to deal with the data that's on the database. So you will not have the luxury necessarily to do a functional analysis, but I think one needs to scrub your first set of comparables quite in detail with whatever access you have to information on the internet about these companies. So that's why the economic analysis, is very important to identify firstly the right industry code. So you need to make sure that you work with the right industry code, and then you have to start with hopefully as wide a basis as possible. Now, I know, for instance, the accounting firms may start with some of the accounting firms have the practice to start with 10,000 comparables and then work them all the way down. I just think that in the end your comparables are not going to be much different whether you start with 1,000, 100, or 10,000. I think it's more when you identify the companies within your sample that you make sure that they are comparable. And unfortunately, you are only left with the information that's publicly available, because the database like Amadeus or Orbis will only give you the financial information, and you won't have a clear understanding or detailed understanding of the functional analysis. So you have to, and that's why it's important to go through your companies over and over and find as much information as possible to see whether that will help you.
So, Okkie, it may then be argued that the OECD methodology encourages excessive focus on the controlled transaction with just surface knowledge of the uncontrolled transactions. Hence, a lot of economically relevant differences are not adjusted for. What do you say?
So again, I think it's important that you make sure that you get your industry code correct, because if when you start your comparable search on the database, because if you get that slightly wrong, your comparables will not be comparable, or they will be very difficult to adjust. So especially when you get into services, it becomes a little bit gray, and you need to look at business, because everyone may list for accounting services, but maybe they're just doing the petty cash for someone, and then it's not really accounting services. So one needs to be very careful in that selection.
On to the next question. In case there is incoherent information in the local file and master file regarding functions or risks borne by an entity, the tax authority may challenge any of the information. Are they more likely to rely on the master file for being a group document?
I think they will. Obviously, that's not a good idea if there's a difference in your numbers. I don't think they will only go for the information in the master file. I don't think the master file information by default trumps the local file. If you depending on, I think, the impact it will have on the taxable income, the revenue will pick the set of information that suits them the best. So this is something, this incoherent kind of information, you have to avoid that at all costs, because as soon as if revenue picks up that difference between master and local file, I believe the integrity of the entire transfer pricing process of that group is under suspicion. So one has to avoid that at all times. And you do state that it should never happen, but and you do have some example. You say experience of multinationals, where it's especially where the headquarters seems to be more mature in terms of the process and review. I think automation of your transfer pricing process is more or less the only solution here. In other words, if you use automation programs, that is around, that will help, because then your more mature headquarter teams can set up the standard information, like the description of the transaction, the business overview, and the subsidiaries, or the smaller teams in the less mature jurisdictions can then just draw standard bits of information out of the database, because your automation is generally based on a standard database. So we don't rewrite the business background every time. We write it once, someone puts it in, it locks it, cannot be changed. If you want to use that business background, you just tick a box and the computer pulls that information into your document by default. So I do think automation is the way to go in these kind of groups, where you've got a big disparity between the experience and the maturity of the tax teams, or in some cases you may not have a tax team in a local jurisdiction. So one needs to look at automation, and if that's something that you are interested in, I work with a few companies in Europe that only focuses on transfer pricing automation, and I do think that is for bigger groups with big differences in the countries where they operate. That's the safest way to go.
If a function is not performed frequently, for example, an exceptional transaction like the sale of an asset, is that not benchmarked, or do you take into account the size and value of the transaction in deciding whether to benchmark or not?
I cannot incur cost for the fact that for a benchmark, for the fact that I sell my plant once every 15 years. And now, so now this year there's a sale of the plant. And yes, the size and the value of the transaction must be considered, but also, if the gain on that sale of asset is substantial, and especially if it's to a group company, you need to look at that. So, yes, we do exclude once-off extraordinary transactions, but if the transaction impacts at all on the business operations, because even if you look at the financials, that sale of the plant, if you take the numbers out, it should look very similar to what it was the year before, or it should be very comparable. So then one needs to, if you're not going to test that transaction, in testing the other transactions, you need to make sure that there's not a service provided as part of the sale of the asset. So it's not an easy spot and an easy decision, but you need to firstly look at how frequently does it happen, what impact does it have on the business of the company. So if I sell my asset and I don't buy a new one, then then how do I do business going forward? Am I restructuring? Am I terminating? What is happening here? So I think it is important that you when it's once-off, don't just ignore it. You need to look at the impact that transaction had on the financials. So if you sell the asset and for 3 months you had no production, then your numbers are going to look very different from when you were operational for 12 months. So one can ignore, you can decide not to test, but you cannot ignore, if that makes sense.
Okay, how would you prove that the asset is not valuable without performing a valuation?
Evaluation always helps. So if you can, I think especially if you do intergroup transfers, I would like to understand why am I selling an asset from one group company to another? Because generally speaking, I only sell my asset if I'm buying a new one. If I just sell it for the fun of it because someone else now starts it, then you may have a business restructure on your hands. So then you can't look necessarily at the transfer pricing, but then you need to look at this is a business restructure. Who's paying for the restructure and who gets compensated for giving what up. So the sale of assets between group companies, to my mind, is not necessarily a concern about the price at which I do it. It's more whether I'm busy with the business restructure, and then I'm not testing that implication rather than focusing on the TP itself.
Okay, is there a simple formal distinction between a supply chain and a value chain?
So I say a supply chain equals how goods or services move through the various entities from raw material to finished product. That's the supply chain. The internet says it's a system of organizations, people, activities, information, and resources involved in supplying a product or services to a consumer. So it has nothing to do with the value add. It just says you dig it out of the ground, you break it down, you melt it, I form it, you sell it, you ship it, you guarantee it, or you service it. So that's the supply chain. Who does what in providing this to the company, and it does not impact on the value. Then your question is, what is a value chain? My words, what a value chain is added by, what value is added by each entity to the product or services. So now you say, okay, what is the key? Is it the taking out of the ground? Is it the breaking? Is it the melting? Is it the forming? Is it the selling? Is it the after sale service? What value is added by each of the companies within your chain? The internet says it's a set of activities performed in order to deliver a valuable product to the market. So a supply chain is a set of organization groups and activities information. A value chain is purely focused on the activities.
What kind of valuable information do authorities want to get by looking at value drivers?
Well, I think when looking at value drivers, they want to understand who plays what role within the value chain. Because I may have given this example before. If you look at Gucci, Gucci, I think that's, I pronounce it correctly, the luxury goods company. People think that maybe it's the design that is driving the value. It's maybe the quality of the goods, the product that they use, the quality of the people working, But if you speak to the guys at Gucci, they say their supply chain department, making sure that the right product is on the shelf in Europe at the right time, that's most important. If you don't have the coats or jackets or warm clothing on the shelves when the Europeans go to buy the product, people are not going to say, oh, Gucci's not here, I'll come back next week. They'll buy the next best. So having a product at the right time in store, that's the biggest value driver for that group. So from the outside, we will think it's different. So that's why revenue wants to look at the value driver to see what impacts me on selling those goods. It's yes, the quality of the good, yes, the design, yes, the brand. But if it's not on the shelf, people are not going to stand around and wait for it for a week or so, to buy it, because they will then just say, okay, you're not here, I will go to the next one. I would have bought it because I know I can trust it, but now it's not on the shelf. I think I can trust the other brand equally. So value drivers are purely there to indicate where the real value is created and who should get the real share of the lion's share of the profits.
Is there a simple summary of the requirements for the assumption of risk?
I can say there's nothing simple in transfer pricing, but then I would be lying, because I think sometimes we overstate it. But so I think the first thing, and being an accountant, I learned this the hard way. Working for lawyers for law firms for quite some time. One needs to make sure that the conduct of the companies in the group, confirms the legal agreement. A legal agreement is only something in writing. You can put anything in writing. People sign on the dotted line. They live the agreement. People change. People move on. New people are appointed, and then we no longer live the agreement. So to my mind, the assumption of risk, I would say, okay, the agreement says that what happens on the ground. Go speak to the people on the ground and make sure that what the agreement says equates to what the people tell you. The people that has never read the agreement, the people that were just employed to do the jobs, do they follow what the agreement says? You need to look at how the agreement allocates risks. Let's take a bank and its credit committee. So I've not seen a bank that will subcontract its credit committee to a third party. So why would that bank then subcontract its credit committee activities to some company in the group that sits in Bermuda? Commercially, it makes no sense, because we say a bank will keep its credit committee decisions and activities internal. It will never give it to a third party. So why is it commercially now giving it to a third party, although it's in the group? So one needs to say, but would a third party do this if the allocation of risks are not based on what third parties would do? Your departure point is problematic. One also needs to look at the consequences of the risk allocation. Why would someone take a risk that commercially no one would take? So that also, and the fact that you compensate them for that risk doesn't mean that it's now right. So one needs to be very careful to think, I'm paying for you, so therefore the right, you must not take the risk. One needs to check that and double check. So I think what's important is that the employees you have to check the capabilities of the employees at the risk taker. Can they make decisions about this risk, and are they actually taking it, or are they back on the phone? 6 of the 8 hours back to the head office to get guidance and understanding. Then you may have a problem. The other issue is the financials. The risk taker must be able to financially have the financial capacity to assume the risk, and it must also have the freedom and the authority to take whatever actions are necessary for it to avoid the risk. So if I take the shipping risk, but I have to go back to head office every time that I want to take an insurance policy out on a freight, then I'm not really in control of that of mitigating my risk. So your financial capacity must be able to carry the risk, but you must also have the authority to do whatever you have to do to mitigate the risk.
Okay, thank you for that, Okkie. Then following on that, so the party must have control over the risk, which means the ability to decide, 1, whether or not to take on or lay off the risk, and 2, how to manage that risk. And then also the party must have the financial capacity to carry or bear that risk if it realizes. Is it then accurate to say that the 2 requirements for the assumption of risk are 1, control, and 2, financial capacity, as described above?
So it's fine. I can have the risk, But if I don't have the financial capacity, someone else will stand in for me in that regard, and then I have to pay some fee to that person that actually takes the financial risk. So business-wise, I may be the one that has to replace whatever the goods were that sank with the ship. But if the head office is going to pay me to do so, then I need to, or is going to assist me in doing that. I need to pay them for that service. So I think it's very important that although I'm taking the risk, if I don't have the financial capability, we need to look at how you allocate those profits. And you're right. If you only carry half the risk, you can only earn half the profit. So levels of authority is very important within a group, but it has to be a board of directors of the holding company can never take responsibility for everything. So it has to delegate things down. But delegation requires responsibility and accountability. So if the person is not responsible or accountable, nothing is really being delegated. So one needs to be very careful with those delegation of rights, of risks, to make sure that it's actually delegated and it's actually assumed, and people are liable, responsible, and accountable. When we talk about risks that we were not aware of, but that materialized, after the fact, and then we said, listen, but you can't now, the revenue cannot, in those circumstances where I wasn't aware of the risk, readjust the profits in the group. Now, when I say I'm not aware of the risk, it's not because I forgot about the risk or I didn't do my job properly to identify the risk. We're talking about scenarios where seriously no one knew that in March to June of this year, most of the world will be in lockdown. So we can't now go allocate the lockdown risk because it happened now, and people didn't take it into account when they priced goods in February. So I'm only referring in that scenario to risks that no one in his right mind, after doing all the work that he was supposed to do, could have known, and now it materializes. And I think COVID is a good example, is that no one could have foreseen this. And you cannot now go, as if your revenue readjust profits to compensate for what happens under COVID.
Okay, thanks for that, Okkie. Then just following on that, where parties rendered intercompany services, for example, advisory services from company A to company B, and the parties failed to recognize those services and take that into account in their pricing, the revenue authority can price it after the fact and make an adjustment. Why is that not appropriate with risk, even if the M&E group fails to have any group members assume the risk formally? Why can the revenue authority not make an adjustment in those circumstances?
I think I've just explained it. So forgetting about a risk, forgetting about a function, or not identifying the function or the risk, that's not an excuse. It's seriously where the risk was, no one would have been able to work that risk out. That's the only one where revenue, where you can expect revenue not to adjust.
Okay, next question. What are going to be the main changes that companies will need to implement in order to be in line with the latest OECD guidelines on financial transactions?
I'm it's from, again, so I think one needs to make sure, well, most companies will have to review their policies to make sure that there's an accurate delineation of the financial transactions and that it's properly documented. My concern is that in the old days, we just said this is a loan and end of the story, and there we go. I think one needs to make pretty sure that okay, there's a loan, hang on, there's a guarantee, hang on, there's a cross guarantee, and there's a subsidy of the interest. So we need to delineate that transaction in much more detail to make sure that we document that. Because I think financial services for too long was just grouped as something, and then we moved forward without making sure that we understand exactly what the transaction is. Obviously, I think we're gonna see some recharacterization of loans, where the lender is maybe a flow through and doesn't really control the credit of the borrower. I'm the treasury company, but I get told that I will grant a loan to the sinking subsidiary of me somewhere in the world, or fellow subsidiary. I have no choice. Head office just sends a memo and say transfer the money. So I have no real control over that risk. So then head office will have to pay me for taking that extraordinary risk. So that will have a major impact on where we're going. I think we need to make sure that there's an analysis to link the interest rates to the risk inherent to the loan. So we will make sure and write a little bit more detail on how we get to the interest rates, how we've determined the interest rates, to make sure that revenue can understand. I think, financial guarantee transactions, again, the delineation of those transactions will have to be revisited. We will have to look at the impact of implicit support as being part of a group versus the explicit contractual guarantees, because those are different new concepts, that's coming to the table to say, how would this impact on the pricing of whatever I get? The question, we'll have to carefully consider where a bank gives me a loan up to X, and because there's a guarantee from the shareholder, now I get more loan. Should we recharacterize that portion of the loan? Seeing that I only get it because of the guarantee. We have to consider the sharing of group synergy benefit in pooling with pooling participants. Especially where the profits were allocated before to the pool lender on a bit of an inconsistent delineation of the transaction. So we have to revisit all our pooling arrangements and make sure that we don't have a situation where some of the pool participants has to get a portion of what is currently going to the pool leader. Our shell captives will have to go, captive insurance companies will have to reconsider, especially where there's no commercial rationale, and we may find that some of our captive insurance lack substance to control the risk, and therefore they are nothing more than a service provider, and therefore we should not look at, we should give them a cost plus for the service, and that's the end of it.
Okay, I'm getting to the end of the question session now, so just the last few questions. I would like just some expansion on the allocation or determination of the profits that will get allocated to the entity that Revenue Authority thinks bears the most risk. So who then determines the most appropriate method to calculate the profits to be allocated? Is it revenue or is it the taxpayer? And then taxpayers allowed to not be interviewed during audits in case they contradict legal agreements or TP policies.
So I would imagine that, in allocating profits, the taxpayer is the first one who will have the first go at allocating the profits, realizing that the revenue and the tax authority will have to look at this and judge. But so it will be largely in the hands of the taxpayer to decide on how to allocate profits, based on the fact that revenue will look at that in hindsight and then try to get to a different result. Then taxpayers are allowed not to. Yeah, so it's very difficult to argue that a taxpayer cannot be interviewed. Revenue, I think, in most of the tax legislation and admin legislation will have the right to interview whoever they want within a taxpayer's organization. So unfortunately, I don't think one can go there and argue that taxpayers can't testify. So I hope I understood those questions.
Okay, so that's brought us to the end of this Q&A session with Okkie Kellerman. Okkie, thank you so much for taking the time. I know that you've got to run, but I just also wanted to say, ladies and gents, those are some really good questions, and the answers I'm sure will be very valuable to you as transfer pricing practitioners or learning about transfer pricing. I just also wanted to say that there is a subsequent a Q&A podcast with Okkie dealing with some questions that we had on the arm's length principle, so please look out for that under the podcast section. Ladies and gents, I also just wanted to point out the topic that we dealt with today, functional analysis, is covered in detail in some of the courses that we present and provide through the International Institute for Tax and Finance. We have the Postgraduate Diploma in Transfer Pricing, and then our online learning platform, which is Quebeco. We do have the Transfer Pricing Masterclass, and functional analysis is dealt with under the TPE Masterclass Module 1. So if you'd like to learn a bit more about this, please take a look at either the IITF website or Quebeco. Both of those website addresses will be posted at the end of this session. But thank you very much for taking the time today to come and listen to these podcasts, and we look forward to having you listen to some more podcasts in the future. Take care.
Before you leave, I'd like to thank you for joining us in this video, and I'd like to remind you to subscribe to our channel. Once you've subscribed, send us an email to info@quebeco.com to inform us that you've subscribed, and we'll send you a free copy of Tax Intelligence by Dr. Daniel Erasmus.